Hey everyone, welcome back to Corporate Decoder, the place where we try to decode the confusing language of business and finance by making it simple enough to understand, and maybe even laugh at. Today we have some fresh filings from the Federal Home Loan Bank of New York, and while it might sound dry, you might be surprised at what we find lurking in these numbers. Stick around as we break down exactly what this means for you. Before we dive in, if you like getting clear, straight answers from these filings and want to make sense of what big companies are up to, make sure you are subscribed. Also, we have a fantastic community over on Discord, all linked in the description below if you want to chat with fellow finance enthusiasts. Alright, so this filing is an 8K report. Think of it as a signal flare from a company to the public saying, hey, something important just happened, and we need to tell you right away. It is not a quarterly or annual report that gives you the whole picture, but rather it highlights specific events. This particular 8K for the Federal Home Loan Bank of New York, or FHLBN, dated the 14th of October 2025, is telling us about their financial obligations, specifically the money they owe from issuing debt. Now, the FHLBNY is part of a larger network of federal home loan banks. These banks are a bit unique. They were created by the government to help local lenders like banks and credit unions get the funds they need to provide mortgages and other loans to people. So in a way, they are a crucial part of the housing market infrastructure. This filing is really about how they raise money to do that, and that is by selling what they call consolidated obligations. These consolidated obligations are essentially loans that the FHLBNY takes out from the public. They consist of bonds and discount notes, which is just fancy jargon for different ways of borrowing money. The most important thing to understand here is that these obligations are not backed by the government like the printing of money. They are backed by the financial strength of all 11 federal home loan banks combined, which means if one bank stumbles, the others have to pick up the slack. This is known as joint and several liability, and it is a pretty significant detail because it spreads the risk but also means everyone is on the hook for everyone else. The filing then points us to something called Schedule A. This is where they list the actual debt they are planning to issue or have recently issued. It is not a simple list of all their debts. It focuses on bonds and discount notes where the FHLBNY is the primary party responsible for repayment. It also includes any debts where they have taken over responsibility from another federal home loan bank. It specifically excludes short-term discount notes that are issued as a normal part of their everyday business, and also doesn't track how much debt is actually paid off or replaced. So while it shows what is being issued, it does not paint a full picture of their total debt either growing or shrinking at any given moment. That information you would find in their more regular periodic reports. This part is interesting. They are saying that the overall issuance of these debts is important to them, but they are deliberately not saying if any single debt issuance is a big deal on its own. This suggests that they are managing a large volume of debt and individual issuances might not stand out dramatically on their own. It is like saying, yes, we are selling a lot of apples, but we are not going to tell you if this particular basket of apples is particularly special or problematic right now. They are also clear that Schedule A does not cover all financial instruments they might use. For example, they might use interest rate agreements to manage their risk, but those won't show up here. This is another crucial point for anyone trying to understand their balance sheet. The amounts listed on this schedule are called at par amounts. This just means the face value of the debt. It does not include any discounts or premiums they might have paid or received when the debt was initially sold. So if you are comparing this schedule to their official financial statements, you will see differences. The financial statements will show the true accounting value after considering these factors, but this schedule is more about the raw principal amount being issued. So what are we actually seeing in Schedule A? This is where we would normally dive into the numbers to see the exact dollar amounts, the types of debt, the issuance dates, and so on. Since we are not going to list every single debt issuance here, the key takeaway is that the FHLBNY is actively managing its funding through the issuance of debt. They are borrowing money to then lend out. The filing does not provide specific numbers on how much money they are raising in this particular report, nor does it give us the context of what is maturing or being retired. It is more of a disclosure that they are continuing their normal practice of issuing debt. This is a disclosure about their ongoing fundraising activities. Finally, the report includes something called an interactive data file. This is essentially machine-readable information that makes it easier for computers to process and analyze the filings. It is like giving the report a digital fingerprint so that financial data gets shared and understood more smoothly across different platforms. So what is the big story here for the Federal Home Loan Bank of New York? Well, it is business as usual. They are continuously raising money through issuing bonds and notes to fund their operations, which is to support lending institutions. The filing emphasizes that this debt is a joint obligation of all the federal home loan banks and is not government guaranteed. This means that the health of the entire federal home loan bank system is critical. While this specific 8K is not a deep dive into their financial performance, it serves as a notification that they are actively engaged in debt issuance. The lack of specific financial figures for individual offerings means we have to rely on their other filings for the full picture of their financial health and their total debt levels. When we look at this filing, the most important aspect is that it confirms the ongoing operations of the FHLBNY in fundraising through debt. There are no dramatically new risks or strategies revealed here. It is more of a check-in to say yes, they are still issuing debt, and this is how they are handling that disclosure. The information provided is technical and focused on the mechanics of their funding rather than the results of their lending activities. It is a reminder that these institutions are pillars of the mortgage market, and their ability to raise capital efficiently is paramount. So to wrap up, the Federal Home Loan Bank of New York is continuing its established practice of issuing consolidated obligations to fund its operations. This filing doesn't reveal any red flags or new opportunities, but rather confirms their reliance on the capital markets for funding. The joint and several liability aspect is the key risk to keep in mind if you are looking for potential vulnerabilities in the system. Alright, that is our breakdown of this 8K filing from the Federal Home Loan Bank of New York. What are your thoughts on how these institutions are funded and the implications of their debt issuance process? Let us know in the comments below. If you found this analysis helpful, please give it a big thumbs up and subscribe for more decoded financial documents. And don't forget to join our growing community on Discord, linked in the description. Thanks for watching, and we will see you on the next one.